Is Ethereum's core promise fundamentally broken? The Coin Bureau channel uncovered a massive disconnect between words and actions. While Vitalik Buterin spoke of mild austerity, on-chain data shows wallets linked to him sold nearly $22 million in Ethereum during a period of extreme fear. This happened as the Dencun upgrade collapsed mainnet fees by 93%, shattering the ultrasound money narrative. This pain for retail investors reflects a wider trend. On CryptoWendy's channel, Charles Hoskinson described the market as a K-shaped recovery, where institutions profit while retail gets left behind by outdated regulations. And many are losing even more through automation. According to Crypto Tips, a staggering 70% of traders lose money, but trading bots actually perform even worse, with a 58% loss rate. So where is the smart money actually flowing? The Lark Davis channel points to the real battle, the AI infrastructure war. The US needs to double its energy production in just 5 years to keep up, while 98% of its advanced AI chips come from Taiwan. This raises a critical question for every investor. Is the future of wealth generation still in crypto protocols, or is it in the energy and hardware that powers the entire system? In the latest video from Coin Bureau channel, we get a look at a complicated situation unfolding around Ethereum. On January 30th, Vitalik Buterin announced the Ethereum Foundation was going into a mild austerity period. He framed it as a strategic move and said he personally withdrew over 16,000 ETH to fund open-source projects over the next few years. The market took a small hit but was mostly reassured. However, on-chain data tells a different tale. Starting just 4 days later, wallets linked to Vitalik began selling significant amounts of ETH, totaling nearly $22 million in just 3 weeks. This happened while the market was in a state of extreme fear, with the Crypto Fear and Greed Index hitting an all-time low. The selling coincided with massive liquidations, wiping out over $2.5 billion in leveraged positions, mostly from retail traders who got hammered. While the sales were public and used methods to reduce market impact, the timing and speed, selling nearly half the allocation in weeks instead of years, created a huge gap between his words and actions. To complicate things further, the Ethereum Foundation itself began staking 70,000 ETH, a move signaling long-term belief, completely separate from Vitalik's personal sales. The video also points out a deeper, structural problem for Ethereum. The Dencun upgrade, designed to make Layer 2s cheaper, has been so successful that it has collapsed the fees paid back to the mainnet. This has broken the ultrasound money narrative, as lower fees mean fewer coins are being burned, making ETH slightly inflationary again. This weakness is reflected in the ETH/Bitcoin ratio, which is near multi-year lows. The institutional picture isn't pretty either, with BlackRock's ETF seeing negative flows and the average ETF investor sitting on major unrealized losses. The whole situation leaves you wondering about the path forward for Ethereum, especially for the retail investors who've been caught in the crossfire. The video paints a concerning picture for Ethereum, and recent market data seems to echo these structural issues. The core conflict is that Ethereum's scaling success with Layer 2s, thanks to the Dencun upgrade, is directly undermining its own mainnet fee revenue. This revenue paradox has broken the deflationary, ultrasound money narrative that was a key part of its investment thesis, leading to a period of mild inflation. This fundamental shift in tokenomics helps explain ETH's persistent underperformance against Bitcoin, a trend noted in the video and supported by historical analysis showing Bitcoin's stronger momentum through market cycles. The institutional sentiment highlighted in the video, with ETF investors underwater, is also reflected in broader trends. Reports from late 2025 and early 2026 confirm that institutions have been trimming their ETH ETF positions amid market volatility. While Vitalik's actions, regardless of intent, clearly spooked an already fragile market, the deeper issue is whether Ethereum can find a new, compelling value proposition. The upcoming Glamsterdam and Higata upgrades, which aim to improve gas efficiency and introduce features like account abstraction, are crucial. The network's long-term health depends on whether these technical improvements can restore confidence and create new demand that outweighs the current fee cannibalization problem. In the latest video from CryptoWendy, she sits down with Charles Hoskinson of Cardano to talk about the state of the crypto market, regulation, and Cardano's new privacy-focused partner chain, Midnight. Charles kicks things off by describing the market as a mixed bag, noting a K-shaped recovery where big, wealthy players profited while retail investors were largely left behind. He expresses deep frustration with the U.S. political and regulatory environment, arguing that policy is driven by big money and loyalty rather than merit. He believes the current approach, based on a 93-year-old securities law, is completely outdated and that recent political moves have unfortunately made crypto a partisan issue. This makes it incredibly difficult to pass meaningful, bipartisan legislation that protects developers and retail users. A major point he makes is that having no new bill is actually better than passing a bad one, as a poorly written law could be used to shut down the entire U.S. retail crypto ecosystem. The conversation then shifts to Midnight, which isn't just a sidechain but a partner chain, designed to bring privacy and smart compliance to many different blockchains, including Bitcoin, Ethereum, and Solana. He explains it's about giving users control over their data, whether it's for DeFi, healthcare records, or interacting with the AI agents that he believes will dominate the internet's future. The goal is to create a system where everyone, from an individual to a massive corporation, plays by the same rules, restoring power to the user. It's a vision for a fairer, more decentralized world where privacy and user control are built in. Charles Hoskinson's frustration with the U.S. regulatory landscape and the sidelining of retail investors is a sentiment that resonates widely within the crypto community. Recent market trends seem to validate his concerns about a bifurcated industry. Since late 2025, institutional players have increasingly set the market's pace, with massive inflows into products like Bitcoin ETFs, while retail traders have reportedly started to drift toward equities after a harsh crypto crash. This pivot aligns with Hoskinson's view that the little guy is being left out. On the regulatory front, his cynicism is understandable. While the House passed the Financial Innovation and Technology for the 21st Century Act, FIT21, with bipartisan support, its path through the Senate remains uncertain, and the current administration has expressed concerns it lacks sufficient consumer protections. This legislative limbo creates the exact ambiguity Hoskinson warns about, where innovation is stifled and developers remain at risk. His solution, the Midnight Protocol, aims to address a core industry challenge: balancing privacy with compliance. By positioning it as a cross-chain service rather than just a Cardano-specific feature, he's making a strategic play for wider adoption, tapping into the growing institutional demand for privacy-preserving technologies in a world of increasing financial surveillance. This move could be timely as the market matures and shifts from pure speculation to demanding real-world utility. In the latest video from the Crypto Tips channel, the host pulls back the curtain on crypto trading bots, revealing a harsh reality. 70% of all traders lose their money, and using bots can actually make it worse, with a 58% loss rate. Before you even think about building one, you need to know about the dark side, which includes widespread scams where fake bots on YouTube are designed to drain your Ethereum wallet. The video points to SEC charges against operations like AI Wealth and AIF, which were essentially modern-day Ponzi schemes. Even with legitimate platforms, the risks are huge. The discussion highlights the 3 API leak and a staggering $1.5 billion hack at Bybit, showing that trusting a third party with your API keys is a massive gamble. The host is clear: never ever enable withdrawal permissions, so why build a bot at all? The value isn't in making quick money, but in the skills you learn, like API integration, automation, and risk management. The video breaks down the options into 4 tiers, from easy-to-use but fully custodial platforms like Pionex to AI-assisted tools like Claude AI that can write the code for you. For those wanting more control, it covers open-source solutions like OpenClaw and FXCKED, which allow for full self-custody. This is presented as the only truly sound approach, as you control your keys. The underlying message is that the current financial system, with its endless money printing, forces people into speculating just to keep up. Building a bot should be treated like learning an instrument. Do it for the knowledge, not the fantasy of a money printing machine. The video's warning about trading bots is more relevant than ever, as the crypto landscape in early 2026 is littered with even more sophisticated scams. Recent reports from Chainalysis show that crypto-related fraud hit a record high in 2025, with scammers stealing over $14 billion, a significant jump from previous years. A major driver of this is the use of AI to create deepfake videos and highly convincing impersonation scams, which grew by an alarming 400% in 2025. This directly validates the video's concerns about fake YouTube promotions and AI-powered schemes. The mention of the Bybit hack, which reports confirm cost nearly $1.5 billion, underscores the systemic risk of custodial platforms. While the video frames bot creation as an educational tool, the rise of accessible AI code generators, as mentioned in the transcript, is a double-edged sword. These tools lower the barrier to entry for learners, but also for scammers creating malicious scripts. The core message to prioritize self-custody and treat automated trading with extreme caution remains the most vital piece of guidance in a market where AI-driven volatility and fraud are becoming increasingly intertwined. In the latest video from the Lark Davis channel, the discussion centers on the intense AI rivalry between the United States and China, framing it as the most significant battle for future global control. While U.S. companies like Anthropic and those backed by venture capitalists are creating top-tier models, China is rapidly advancing by building a complete, government-funded AI stack. Experts like NVIDIA's Jensen and Elon Musk have pointed out that China is closing the innovation gap at an alarming rate. A critical advantage for China is its massive investment in energy infrastructure. In 2024, it added over 8 times more new energy capacity than the U.S. This is a huge deal because the U.S. is facing a severe power shortage, needing to double its energy production within 5 years to support its AI data centers, a task complicated by grid connection delays of up to 8 years. The U.S. also has a major dependency on Taiwan, where TSMC produces 98% of the world's most advanced AI chips. For investors, the real opportunity isn't in the AI chatbots themselves, but in the essential infrastructure that powers them. This means looking at energy, specifically nuclear and uranium stocks, like Constellation Energy and Chemico. It also means considering AI data center companies, many of which are cleverly pivoting from Bitcoin mining, and essential raw materials like copper. The message is clear. The fortunes of the AI future will be made by investing in the picks and shovels. The video's focus on the AI infrastructure race between the US and China is more relevant than ever. Recent reports highlight that the US power grid is severely unprepared for the surge in demand from AI data centers, with some projections showing a 40% power shortfall by 2028. This energy bottleneck is a tangible threat to American AI dominance, just as the video suggests. Meanwhile, China is strategically leveraging its massive build-out of energy as a cornerstone of its AI strategy, viewing electricity as computing power. The investment thesis of focusing on picks and shovels is also playing out in real time. The trend of Bitcoin miners like Mara, Riot, and IREN converting their energy-intensive operations to high-performance computing for AI is accelerating, driven by declining mining profitability and soaring demand for AI processing. Furthermore, the demand for raw materials is surging, with analysts predicting I will significantly drive up the consumption of copper and uranium in the coming years. The geopolitical risk surrounding Taiwan and TSMC remains a critical vulnerability for the West, prompting significant investment in onshoring chip manufacturing, though this is a slow and costly process. This all points to the video's core argument. The foundational layers of AI power, chips, and materials are where the most critical strategic and investment battles are currently being fought.
After analyzing these 4 different perspectives, a clear and concerning picture emerges for the average crypto investor. Across the board, there is a consensus that the market is becoming more hostile for retail. Whether it's from institutional dominance, creating a K-shaped recovery, massive liquidations on Ethereum, or sophisticated trading scams, the little guy is getting squeezed. But the source of this danger is where views diverge. Is the biggest threat internal, like Ethereum's broken tokenomics, or is it external, from hostile U.S. regulation? The key takeaway is that navigating crypto now requires looking beyond price charts. Understanding these deep structural risks is no longer optional.